back. My name is Bill Drexler, and if I haven't met you yet, I'm a certified financial planner with Financial Cornerstone Group. And in today's video, I wanted to talk about the types of investment risk. So a lot of folks will think about risk in terms of the overall market, because that's what gets headlined, that's what on TV, that's when you think of risk in investing, market risk is the first thing that comes to mind. However, there's many types of risk when it comes to investing, and we're going to touch on a few of them today, a few of the main ones. But just to start, there are two overall main types of risk. And the first is called systematic risk. And this is a risk that is involved in the whole market, the whole economy, and things that are not easily diversified against. And we'll start with those. And secondly are things called unsystematic or idiosyncratic risk that might be more associated with an individual company, an individual stock or position or government that we can hedge against a little bit more easily. So we're going to talk about some types of risk. We're going to go into maybe a couple examples of those, and then how do we protect ourselves from them. And I hope this helps. Let's get started. So let's look at the first of the systematic risks, and that is inflation or purchasing power risk. And this risk is that as things increase in value and in cost, and it could be either through normal inflationary pressures or more extreme jumps in inflation, such as we saw in 2022, it'll cost more to purchase the same amount of goods and services as it did before. So as inflation increases, the cost in goods and services go up, and the value of our dollar goes down. It takes more money to purchase those goods and services. And a natural hedge against that are equities. The U.S. stock market as a natural protection against inflation and purchasing power risk in retirement, as well as real estate and treasury and inflation protected securities. So the next systematic risk that we're going to talk about is interest rate risk. So the prices of securities generally move in inverse to interest rates. So as interest rates go up, the prices of existing debt securities such as bonds will decrease. In a high inflationary period, such as we saw last year in 2022, the Fed may want to wrangle in the prices of goods and services with raising of interest rates. So they're taking money out of the economy. They're making it harder to get money, to start businesses, to get a loan, things like that. And that also affects consumer purchases, and ultimately it affects corporate stock prices overall as well. So diversification, portfolio immunization with duration matching can assist here. So let's look at the last of the systematic risks that we're going to be talking about today, and that is market risk, the one that everyone automatically thinks of when they think of risk when investing. And that's the risk of losing value in our investments due to uncontrollable or unforeseen events. And these can be such things as large macroeconomic events. These can be wars, pandemics, and they're generally things that affect the performance of the overall market. Market risk can also be seen during natural recessionary periods in the business cycle. Market risk cannot easily be mitigated through portfolio diversification alone, but we can look at sector rotation towards consumer staples, healthcare, energy, other defensive stocks could help as well. So we're going to switch gears here a little bit and talk about unsystematic risk or idiosyncratic risk. Things are more associated with an individual company, individual position, individual government. And the first on our list is business or company risk. That involves investing in a single company. That company fails, and thus we lose our investment or a portion of it and have to sell it at a significant loss. And this involves the risk of you losing your original value or the investment totally. This is the very reason that we diversify across multiple companies, industries, sectors, and asset classes. Next up on our list is liquidity risk. So this involves our invested not being able to readily be turned into cash if needed, risk needing to dispose of a security at a price that is less than what we paid for it should you have a need to take it. An example of this is an annuity that is still in the surrender period of time and some limited partnerships. This can be hedged against, aside from investing in liquid assets such as stocks, mutual funds, ETFs, but also cash flow matching of their future liabilities. So next up on our list is longevity risk, and that's the risk of outliving our money. As we are living longer, we're saving less, we're waiting longer to start saving, and as well as companies not offering employee pensions anymore, a big risk for folks in or nearing retirement is running out of their savings, running out of their money. This risk involves not taking inflation and taxes into account when you're doing projections in retirement. And a good protection against longevity risk is to look at life after retirement, how much we have saved, the cost of living, including healthcare, taxes, and inflation into account, and running different scenarios to see if we can live the life that we want to live. And investing accordingly, only taking the risk needed to achieve our goals. So the next three risks that I'm going to be discussing are geopolitical, sovereign, and currency risk. And as I mentioned, the next few involve investing in foreign securities or foreign governments themselves. So geopolitical events can cause volatility in the markets, and a perfect example of this is the Russian invasion of Ukraine in 2022. The economic stability of another country can impact investment within that country, and that's where we can see some risk, including sovereign risk, and the chance that a foreign government can't fulfill its debt obligations. And finally, with exchange rate risk or currency risk, that involves investing in foreign investments, and you're facing unpredictable gains or losses due to the changing of the value in one currency in relation to another currency. If the value of the dollar were to go up, the cost of a foreign investment might go down, potentially. So a natural protection against these are doing fundamental and technical analysis on the foreign company, the government, and diversification. Next up on the list, we got credit and default risk. So this is a risk that a creditor, whether it's a business or a government, defaults on the debts and they cannot satisfy the terms of their obligations. A natural outcome of this is a restructuring of that company or government's debt obligations. And also this ties into another risk, reinvestment risk, where if an investment has to be liquidated, it comes due or ends, for lack of a better word, you may be forced to invest the proceeds at a lower rate than what you were before. And a good example of this is if an investor is forced to liquidate a 5% CD that they had, and the new equivalent CDs are only paying 2%, that's a perfect example of reinvestment risk. And finally, this is a really big one. This is a sequence of returns risk. And I have a whole nother video of a seminar that we were hosting where I talked about that and had a whole longer example that I think would be beneficial. So if that interests you, click on the link and it'll bring you to it. But for the purposes of this video, sequencing of returns risk involves having suboptimal returns in our earlier years of retirement. We still need to take money out while the market is down. So really what we're doing at that point is we're locking in losses, not allowing for those funds to return in value. And that affects the rest of our retirement years. Being a bit more conservative in our earlier couple years in retirement and looking at downside protection and diversification can be beneficial here. Well, I hope that this helped everybody. Obviously, we didn't talk about every single risk involved in investing, but I did want to hit the highlights, hit the big ones, and offer a little bit of some suggestions. Obviously, these aren't recommendations because I don't know your specific situation. So make sure that you talk to a trusted professional, certified financial planner, CPAs who can say, hey, based on your specific situation, this is what we recommend to do. If this helped, please like, subscribe, share it. We'll see you in the next video. And until then, be good to yourself and be good to everyone else.